Welcome to Blind Spots, a podcast where we're helping you fill the gap between what you want to do with your money and what you actually do. We are professional investors, writers, and financial planners helping you navigate the complexities of finance to optimize what you can control and cut out the rest. Join your host, Nik Schuurmans and Erin Varghese, as we discuss the questions and nuances surrounding everyday money management. Investment advisory services offered through Pure Portfolios, a registered investment advisor with the U.S. Securities and Exchange Commission. Nik Schuurmans and Erin Varghese work for Pure Portfolios. Any opinions expressed by Nik and Erin or any podcast guest are solely their own opinions and do not reflect the opinions of Pure Portfolios. This podcast is for informational purposes only and should not be relied upon for investment decisions. It should not be construed as legal or tax advice and is not intended to replace the advice of a qualified attorney or tax professional. Clients of Pure Portfolios may maintain positions in securities discussed in this podcast. This information is not an offer or solicitation to buy or sell securities. The information contained may have been compiled from third-party sources and is believed to be reliable. Hello everyone, and welcome back to another episode of Blind Spots. This week, we are kicking off today's episode, starting with a quote by Jack Butcher. Nik, who is Jack Butcher?
I don't know who Jack Butcher is. Some random guy on Twitter, but It's a golden quote. And I'm sure Jack is a smart guy. He might have taken this from Morgan Housel, who wrote The Psychology of Money, which I'm fond of. But the quote is, "You get rich by taking large amounts of risk with small amounts of money. You stay rich by taking small amounts of risk with large amounts of money." And this fits into our theme of building wealth and keeping wealth require two very different mindsets, and most people never make the switch.
Yeah, well, whoever Jack is or whoever wrote the quote, it's a good one. So I feel like we discuss risk and portfolio positioning in just about every episode of Blind Spots, but today we are going to be discussing the two main pieces of your financial puzzle because you can't have one without the other. So today's episode is all going to be about how your financial plan and your portfolio work together.
That's great. And I can also say, and this is related, that most people tend to make decisions, financial decisions, in a silo. So they'll look at their portfolios. They'll look at the Social Security equation, and then they'll look at their financial plan. It's like you should be making all of your decisions within the context of everything that you have going on. Because, I mean, you can think of it as little levers. As you pull one, then another might move. And if you're not looking at the whole picture, you're going to miss how the levers interact.
Yeah, I think that that's a great visual. So we think about your financial plan. It's not a finished product. We're always working, we're always tweaking. But if you've listened to Blind Spots before, we're not going to be serial tweakers. But we look at it as a roadmap to see how you will accomplish your goals, and we use it as a tool to help you make educated and evidence-based decisions. So how does your portfolio tell the story of your financial plan?
So you can take it from the standpoint of the financial plan and back into the investment portfolio. Like that's what I prefer to do. And we're going to talk a little bit more about how someone can do that. The consistent story that your investment portfolio and your financial plan need to tell would go something like this. I'm aggressive in my investment portfolio because I have more than enough. I have more than enough assets to meet my lifestyle, my expenses, my philanthropic needs, and my assets are going to my charity or grandkids anyway, okay? So you've identified your aggressive portfolio not only satisfies your needs today, but your timeline, your run rate is much longer because you're not investing for you, you're investing for your grandkids, your kids, your charity, or whatever. On the flip side, if someone were to say, Nik or Erin, I'm conservative in my investment portfolio because I have more than enough. I have enough to satisfy my current lifestyle and needs and all that. But I'd like to sleep at night, okay? So that conservative portfolio makes sense. They have more than enough. They don't need to seek risk. At the same time, you can make a case that they could seek risk because they have more than enough. But the next layer is your investment personality, your personal experiences that shape the way that you view money. So in both of these cases, the aggressive and the conservative investor are telling a consistent story.
I like how you frame this to clients. You often ask, what is the game that you're playing? Because it really allows someone to put themselves in that mindset of how they should be thinking about their life, their lifestyle, their mindset,
Yeah, and most people, where most people fall short, and this goes back to the opening quote, is they risk what they need for
Mm.
what they don't have and what they don't need. And a cleaner way to say that is many people continue taking risks when they don't need to. And I said this time and again to our clients, I say it during almost every client meeting. Taking a risk where the best case scenario doesn't change your life for the better. So taking a $3.5 million portfolio and turning it into $5 million doesn't change your life. But taking that 3.5 and turning it into 1.5, that could potentially derail your entire plan. That's a poor trade. That's a poor trade.
Yeah. And in that kind of scenario, you may not be at risk for, say, running out of money, but like you just said, it could change your lifestyle. It could change how you feel. So there's a lot of factors at play.
Yeah. So the way you address that, the way someone would address that, again, identify the game that you're playing is part of it, but it's also a shift in mindset. I mean, when you think about most people's careers, like I just turned 40, I'm in my wealth building, career focus mode. I'm taking risk. I've got a seeking opportunity mindset. And
Mhm.
most people have that throughout their careers, right? You want
Yeah.
to build wealth so you can check out someday and play golf and do whatever you like. Where most people miss that is they never turn off that mindset. They'll retire, they'll check out, they no longer have income, but they'll keep in this wealth seeking, wealth creation mode. And they don't need to. So staying rich, like I just talked about building wealth, that's the building wealth mindset. Keeping wealth mindset. Characteristics would include being content with what you have, finding your enough, being measured, not actively seeking risk. Getting rich and staying rich require two completely different mindsets. So where I like to start is running the financial plan and then backing into the correct investment portfolio.
Because you identify all of the other pieces that you need in order to know what the correct allocation is for the specific individual. So on the flip side, what does a portfolio position say about a person's financial plan?
Well, it can say one of two things, and I kind of hit on this in an earlier example, and then I'll talk about how we actually use the financial plan to start the portfolio construction process. So when I see someone that's super aggressive, and I'm going to explain people that are doing it correctly, that have consistent stories. So when someone is super aggressive, I can say that they probably have enough and they probably have goals that extend after their life, either passing money on to heirs, setting up a foundation, yada yada. If I see someone that's super conservative, you can maybe make the case for the same thing, like they have more than enough, but maybe they're just gun shy. Maybe they had a bad personal experience and they don't want to lose money. They like to sleep at night. So that's kind of the extremes. But when I say I like to start with the investment portfolio to start the portfolio construction process, what I mean by that is we want to run a financial plan. We want to map out income, expenses, your goals. We want to be pretty aggressive with our assumptions too. Like we want to create your ideal life, right? Once we do that in the return assumption, right? So you've got your investable assets. We have to assume a rate of return over the next 10, 20, or 30 years.
Mm-hmm.
We set that to 0. And if your plan is favorable with a 0% rate of return, the world is your oyster. You can do whatever you want. You can be super conservative, you can be super aggressive, and it all works. Now, there's a caveat there. Let's say you're super aggressive and you lose 90% of your assets. Maybe that wouldn't work, but that's why we run stress tests, and that's maybe a different topic. But it's an empowering place to be to assume 0% return over the next 30 years and have your plan be favorable. You don't need to be bailed out by the financial market. So setting your rate of return to 0, that's a great starting point. If your plan is favorable, you can make the case for a conservative or aggressive asset allocation. What if you ran your financial plan and it was not favorable at 0% returns? Okay, now we're kind of getting into the portfolio construction piece. You tweak up that rate of return to 1%, 2%, 3%, and you rerun the plan to see how the outputs change. And there should be a point where as you uptick the rate of return, let's call it 4 or 5%, the plan is favorable. That's a starting point for the asset allocation. We can actually back into a mix of stocks, bonds, and other assets that would historically have produced a 4 or 5% return. And then we bring that to the investor's attention and we say, okay, this is the starting point. From there, you can tweak risk up, you can tweak risk down, but that is how someone could back into the correct asset application.
Yeah, and again, that just gives you a framework to make evidence-based decisions. It's not I think this will happen, I'm assuming this could be true. It's you've got facts to back up what you're doing.
Yeah, and it's a consistent story. So back to our open. If someone asks you why you're a balanced investor, well, I ran a financial plan. We assumed a conservative rate of return, and this was the portfolio that if historical averages are even in the same neighborhood, should deliver my desired outcome, right? That's a simple, consistent story. And if someone was just to look at your investment portfolio and ask why you're a 50-50 investor, let's say, well, it fits with my financial plan, my expenses, my need to take money out of my investment portfolio, and it allows me to achieve my goals. Boom. Like you can say it either way. The story makes sense.
Yeah, I think we run into a lot of people who don't have the framework for making decisions. And so it's just kind of when they come to us, their plan is just kind of a hodgepodge of.
It's a collection of random investments. They don't know how much risk they're taking. They don't know how it jives with their plan. Like there's no context. It's all siloed off. Yeah, there's no story. And people usually have a good mental account of what they have. Like, oh, I've got my short-term monies. I've got my CDs here. I've got my Edward Jones account. I've got my Roth account over here. I got my old 401k that I never moved. But those aren't talking to each other. Both from an investment standpoint, like you could be taking more risk than you set out to.
Yep.
You could be holding more cash than you set out to. We basically knock down the walls of everything and get your plan, your investments, all speaking to each other. So you're speaking one language rather than 30 languages.
Yeah. So let's talk about a margin of safety, because when we look at running someone's plan, the first thing we're looking at is to make sure that they don't run out of money. So after we've added in all of our different scenarios, we've stress tested the plan, oftentimes people want to know, what is that buffer that I should keep in my plan just in case after X, Y, and Z worst case scenario happens, that I still have just that little bit more.
So margin of safety is your plan not going according to plan. So think 2020, that was a random year, random stuff happens. I think we all would do well to be more comfortable and not as surprised when random stuff happens, because life is full of randomness. And what we do for clients is bulletproof their plan. If the stuff hits the fan, if life happens, if we get a squirrely market, your plan is bulletproof, okay? And the way we get there is optimizing the things that we can control. So how to build a margin of safety in your plan when things don't go as planned. So one, assume a low rate of return or assume a zero rate of return for your financial plan. Like that return assumption that you need to input, assume something less favorable for you, conservative. All of your expenses, if you spend 60 grand a year and you think that is a conservative estimate or you're not quite sure, bump it up to 75 grand a year. Okay, so be super aggressive on the outflow, on the expense side. If you have a travel goal and think, sometimes on an average year, I might spend 10 grand a year on travel, make it 15 grand a year, okay? And go on down the list and make your outflows outsized and make your return assumptions conservative. Lastly, worst case scenarios. Model a 50% market decline. Model a long-term care event in 10 years. Like you're in cognitive decline and you need assisted living care. Okay, so model some of these worst case outcomes. So combine with low returns or negative returns or 0% returns even. Max out your expenses, max out your goals, model some ugly scenarios, and see how your plan ends up. If it's still favorable, rip off your shirt and sprint around the room fist pumping. That's a good place to be.
It's a good time to celebrate. So the other factors that we talked about, I guess this goes more so on the assumption side of, and you kind of covered this, but of being super aggressive on outflows. So like you said, expenses, worst case scenarios like long-term care events, anything that you're planning on doing, always build in that extra buffer. And then anything that's incoming, like pensions, Social Security, inheritance, anything that's incoming, be super conservative with it and build in that additional buffer.
Yeah, so that's a good point, Erin. It's not uncommon for us to hear clients say, oh, my family owns a parcel of land. I think I can get 350,000 for it. Well, assume you're going to get 100,000. Just make everything horrible for you, basically, and then run the plan.
And in addition to return assumptions, another assumption that we just have to build in is inflation, but it's good to be more aggressive on that side as well. Or things like Social Security, it technically is what it is, but sometimes there's a larger cost of living adjustment, sometimes there's not. So
yeah, and the inflation one is tricky. I know that's the word of the day for people. Everyone wants to talk about inflation. But I can tell you, we all have our own personal inflation number. And I say this all the time. What's true for Nick is not going to be true for Erin. When Erin lives in Florida, her inflation number is going to be different from me when I lived in Pullman in college. So it's like the inflation number, I think, should be more reflected in your actual personal expenses rather than getting all hung up on what to assume for inflation.
Yeah.
Okay. The other factors that can go into the asset allocation and making sure they complement your financial plan is some of our clients and some people have pensions. They have outsized pensions that more than cover their monthly expenses. Okay. If that's the case, again, that frees someone up to either take a bunch of risk with their investable assets or zero risk with their investable assets. So then the next phase is the investment personality, your own personal experiences. If you sleep well at night, invested a certain way, or if you sleep worse, invested a certain way. So then we get into the more investment personality, okay? And then the opposite is also true. If you have zero pensions, and maybe you retired early, you're not taking your Social Security, and you're living off your portfolio, that does affect the asset allocation too. So nothing is black and white. There's nuance to everything. And these are all the things that we go through as we build out the plan and how that dovetails into the asset allocation.
Yeah, and for those who are listening, this can be a quick 5 or 10 minute exercise with yourself. Think about all of the things that you have. What are they doing? How do they correlate? And then just build your story in your mind. Say it out loud to yourself or to a spouse or friend. Does this make sense? And I think that that's a good way to just do a self-check. And if it makes sense, great. Keep doing what you're doing. If it doesn't, reach out to a professional or your advisor.
Yeah, and this is the last thing, and I don't want to sound too aggressive, but I've been doing this a long time, and people like to obsess about external factors that they can't control. And I'm not going to say optimize the things that you can control. I've said that enough. That's like a mantra that we live by at Pure. But I can tell you, the biggest boogeyman out there that could derail your plan is not the Fed, not inflation. It's not who's sitting in the White House. It's not a sector or a stock market drawdown. It's you. You are your own worst enemy. Okay? So educate yourself, have some self-reflection, be honest with yourself, bounce ideas off your spouse. And if you get tied up in the emotion of money and decision-making and are a worrywart, and you're obsessing about every ebb and flow in the financial markets, find an independent, professional, credentialed advisor. It's worth the weight in gold because it acts as a objective buffer between you and your money. And a lot of people don't want to pay fees and all that, and that's fine. But if you're being honest with yourself and you're stacking up the cost of paying for professional advice versus the potentially catastrophic mistakes that we see people make, or that we see people make, it's not even friggin' close. It's not even close. I'll quit talking.
Speaking of optimizing the things that you can control, this is a great segue into our bad actor of the week. The Securities and Exchange Commission, aka the SEC, says that it has reached yet another settlement over alleged violations of mutual fund share class selection and the payment of 12B1 fees.
Why the SEC is interested in this, what advisors do, and why it's a red flag?
So the fact that they invested in those things is not the problem. It's that they didn't disclose it. Like all of those things are not illegal, right? They just didn't tell their clients that there is a conflict of interest.
Okay.
Yeah.
So there's a few things here. One, 12B1 fees have been a major point of emphasis for the Securities and Exchange Commission over the past couple of years. Like we track financial firm crimes and fines, and this is by far at the top of the list, really starting in like 2019. And basically what happens is advisors sell mutual funds with an embedded extra charge when they could be using the same mutual fund, same underlying investments, they could be using a lower cost version of that fund. And they're receiving kickbacks from the fund company to use this more expensive version. The client has no clue, okay? So option A, option B, same exact investment, same everything. Fund A costs 50% more, the advisor gets the difference without telling the client. That's a major no. It's a breach of the fiduciary duty. There's conflicts of interest because the advisor is incentivized to use these higher cost funds. Like, this is reason number 1,000 of why I hate mutual funds. One fund could have 8 different versions, 8 different fees. Client never sees it. It's not on your statement. Your advisor doesn't talk about it. There's conflicts of interest. It's like, why the hell is anybody investing in mutual funds through an advisor? It makes no sense. But like, half of Wall Street firms do this. Half of retail wirehouses, insurance companies do this. It's more than half, and it's very confusing. And I'm glad the SEC is cracking down. And if you're wondering why we're even talking about this, you would be surprised how many people that think all advisors are the same. Mm-hmm. And if someone is just paying attention and reading, not that people do this, but if I'm hiring a financial advisor, I'm going to at least be paying attention to some of the pitfalls and mistakes that investors make and blind spots that they have. But people work with these large firms, and they think just because they're large and they've been in business for 80 years, that this stuff doesn't happen. I mean, the biggest offenders of the 12b1 mutual fund scams are large Wall Street firms. Mm-hmm. This guy happens to be in smaller Ohio-based independent advisor, but note that this stuff has been going across Wall Street for years. So that's why we're pointing this out. Not all advisors are the same. Do your research. There's a trove of information online. You can actually look up to see if the advisor you're about to hire or the advisor that you're working with has any disclosures or marks against them. You can go to investor.gov, you can go to the SEC website, and it's all right there.
Yeah, and for the advisors that work at broker dealers, you just type in the advisor's name and then FINRA after it, FINRA. They have Series 7 licenses. Those disclosures will be listed there as well.
Yeah, this is a big no-no. Pure doesn't invest in mutual funds. We don't own mutual funds. We hate mutual funds. If you're investing in mutual funds in 2022, in my opinion, you're doing it wrong. In my opinion, you're probably paying more than you need to. And in my opinion, there's a better way to do that. I'm saying in my opinion because we have to be compliant. I can't talk in absolutes, even though I want to talk in absolutes. So I'll quit talking.
I think that you have a good opinion. Thank you for expressing it. Okay. Thanks so much for listening to Blind Spots. We'll see you in our next episode.